all Bitcoin and other cryptocurrencies are a phenomenon. Once fiat currencies go, there is no reason for their continued existence. The only money that will come back is gold and silver.
Please join us for our next live stream Sunday, November 22nd at 9 p.m. Eastern. We'll go over current events, past guests, and of course, gold and silver news. Once again, our next live stream will be Sunday, November 22nd, 9 p.m. Eastern. See you then. Hello again, everyone, and welcome to another edition of Silver Bullion Television, SBTV. I'm your host, Patrick Vieira. Once again, if you are new to our channel or if you haven't already done so, please do subscribe. Hit the bell to be notified of new updates and give us a thumbs up if you like what we do. We truly do appreciate your support. Alasdair Macleod joins us today. Alasdair is the head of research at Goldmoney. His experience in the financial markets include being a stockbroker and member of the London Stock Exchange. For most of his 40 years in the finance industry, he has been demystifying macroeconomic events for his investing clients. His accumulation of this experience has convinced him that unsound monetary policy is the most destructive weapon governments use against the common man. His mission today is to educate and inform the public in layman's terms what governments do with money and how to protect themselves from the consequences. We're delighted to have Alasdair with us today. It's time to saddle up and silver up for Alasdair Macleod. Alasdair, welcome to SBTV. How are you doing?
I'm fine. It's very much my pleasure to be with you.
Alasdair, thank you for coming on. Really do appreciate it. It's a privilege to speak with you. You know, I understand that you began your career as a stockbroker back in 1970 on the London Stock Exchange, and stock markets back then, they seem to have peaked from mid to the late 60s. Looking back, was your decision to be a stockbroker influenced by the exuberance in the stock markets back in the 60s?
Not really, because when I first started, well, before I became a stockbroker, I didn't really know very much about it. All I knew was that stockbrokers made money, and that's what I wanted to do. So I came down to London from Scotland, and I managed to get a job as a blue button, which is the lowest form of life on the stock exchange floor. And it just went from there.
Back at that time, do you recall your reaction and those around you when President Nixon announced the temporary closing of the gold window back in 71?
Yes, I do. I mean, you know, amongst us youngsters, we didn't necessarily know the full implications of this. But it soon became clear when the gold price really started rising. Before that event, the gold price was already rising, and the London gold pool had failed. America had refixed the dollar gold exchange rate at, I think, up to $44, something like that, from 35. You know, it had happened under enormous pressure from the markets. So we could see, I mean, even an inexperienced blue button could see that what was happening was the failure of a system. But whether we knew the full implications of that, I think that only really became visible to us as the 70s decade progressed, because we saw price inflation, certainly in the UK, take off. It didn't take off quite so much in domestic America, but nonetheless, the 70s turned out to be a decade of price inflation, which was only ended really when Volcker raised the prime rate up to over 20%. I think that was 1980-81, round about there. But until then, price inflation was a huge problem. And not only that, but we also in the UK had enormous political problems, which sort of led to the stage where literally there was talk in the city of the need for a coup d'etat. I mean, can you imagine it? This is third world stuff. And remember also that Britain went to the IMF for a rescue package. Now, this is unheard of, because the whole point of the IMF was to rescue developing nations if they got into trouble, not advanced nations like the United Kingdom. So it was a very, very bad time politically as well as economically.
Was this one of the things that led you down the path to understanding what sound money is?
I think the full implications of the importance of sound money is something that evolved, if you like, over time. But my background really was like like you in Hawaii, can I say? Because you come from Hawaii, you tell me. I was a colonial. I came from Africa, East Africa. I spent my childhood there, and that was a country which had been built up on private enterprise. And so we knew the value of private enterprise, and not only that, but we knew how obstructive government could be whenever it tried to do anything with the best possible intentions. So I was very much in the mold of a free marketeer. I never bought into the Keynesian idea of the state having a role in the economy. But the importance of sound money, I think, really only became obvious to me over the decades since then. And of course, it is particularly apposite in this millennium when the printing of money has increasingly been the resolution to all problems.
Yeah. Got to ask you about that with all that printing of money. People expecting inflation to come, deflation, inflation. But getting back to sound money, gold and silver, are they two of the things that you would consider to be sound money today?
Oh, absolutely. They are the only form of money that is completely beyond the control of government, other than governments banning you from owning it. But if they tried that now, as Roosevelt did in 1933, I don't think it would get any attraction at all. I mean, all that would happen is civil disobedience on a monetary scale, with respect to money, as well as all the civil disobedience that seems to be mounting in America in the current political situation.
We live in interesting times where there seems to be no detrimental effects between or with the unabated money printing. However, debt has it's never been higher and inequality has never been wider. And the root of this, it seems to me, is the difference between sound money and weak money. How far have we moved away from sound money, and to what extent are the problems we have today where they can be laid at the doorstep of fiat currency?
Well, we've moved away from sound money completely. I mean, that was the point about the 1971 Nixon abandonment of just that shred of sound money backing the dollar. I mean, the dollar actually hasn't been properly backed really since the First World War. I mean, digressing slightly from your point, Benjamin Strong, who is the first chairman of the Fed, used the expansion of money in conjunction with the expansion of bank credit to develop the roaring 20s, as it were, after the 1920 depression. There was a very sharp depression following the war, but then the American economy recovered very rapidly, fueled by excess money and credit. And of course, that led to the Wall Street crash and banking crisis and all the rest of it, which followed. As far as the sort of social situation, which is, I think, what you were really asking, I think it is very important that to understand that the root of this is, in effect, unsound money. The reason for that is that it is unsound money that allows government to intervene in anything, because unsound money gives it the means to finance the interventions, which it does on epic scale. And the development of the welfare state, for example, wouldn't have developed nearly as much with sound money. And this is why you had the imperative, if you like, from the government's point of view, to get rid of the people's money and to introduce its own, so it could take control over the development of the economy rather than leaving it to free markets. If they had left it to free markets, the levels of unemployment would be far less. There would still be the cyclical boom and bust, but that is not a consequence of free markets. That is a consequence of fractional reserve banking. That could have been addressed, and that element of it stopped. If that had happened, I mean, this is all what if, so it hasn't happened, and it's not relevant to what's happening now. But I think the point I would like to make is that if you followed a course of sound money and actually understood what sound money was and incorporated credit within that, so that credit expansion was either severely limited or stopped entirely, then you would have had the sort of economic conditions that we had in really in the Western world, if you like, UK predominantly, Western Europe, but also America. We had the conditions really of enormous economic progress, and we lifted people. And we look at it from here and think in terms of, the workhouses and the slums and all the rest of it. That's actually not the way to look at it, because before the Industrial Revolution, which was progressed on the back of sound money, the condition of the average person was really very, very miserable, far more miserable than the Dickensian situation, which, of course, the socialists claim as evidence of the failure of the free market. Not at all. Things were far worse. I mean, that was the whole point about, for example, removing tariffs on trade, which was Peel's, the Prime Minister at the time, Peel's great achievement. That meant that people no longer had to pay high prices for food, and it allowed them, particularly with the increased employment in the factories, to be able to buy other things. And that was how this division of labor really blossomed under the Industrial Revolution. But it was done on sound money. It did not require money printing to achieve it. And I think it's very, very important to understand that lesson.
Yeah, you touched on all that money printing and fiat. Can we say with, let's say, 100% certainty that the U.S. debt is mathematically beyond repayment now, and that default is most likely the only way out?
No, we can't say that at all. I mean, if we go back again to other examples, the United Kingdom back after the Napoleonic Wars had a far higher level of debt to GDP. Following World War I, World War II, similar stories. The difference this time is it's a peacetime situation. I think what I would say is it's extremely unlikely that they will deal with the debt other than by collapsing the currency or facing a currency collapse, because they don't have the political will to do it. And indeed, they don't have the political mandate to do it. I mean, can you imagine that, if a government ahead of the situation deteriorating more decided to try and stop the deterioration and deal with all the issues head on, the political situation would become completely intolerable. They would not be able to achieve it. And that is the trap in which governments have found themselves. Having said that, it is possible, though politically it is ruled out, it is possible to deal with the debt situation. And this has happened before, and you can deal with it under sound money. But what you require is for governments to cut their spending, to reduce their presence in the overall economy to something under 20% of the total GDP. Now, when you've got governments in Western Europe typically running anything between 40 and 60% of GDP, you can see what a revolution that would cause.
Yeah, that's a great point there. You mentioned the word collapse. I want to ask you about something you had written in an article recently. Eurozone banking system. You mentioned that it's a heartbeat away from collapse. Why did you mention that?
Well, the first thing is that the Eurozone banks, well, let's go right down from the sort of bottom of the story. The Eurozone, through negative interest rates predominantly, has just created a huge great zombie zone. I mean, the business in the Eurozone is basically turned into a zombie. It is absolutely riddled with malinvestment, by which I mean investment that is not producing anything. Companies which should have gone bust have not been allowed to go bust. That creative destruction that Schumpeter referred to has not been allowed to happen at all. The result is that the economy basically is dead in the Eurozone and is irretrievably dead. Now, the next layer of this is the financing of it, and that is the banks. The banks have huge levels of bad debts. But an interesting thing is that they have dealt with this in a way which has come about through national regulation. If a national regulator looks at a bad debt and decides that actually it is a performing debt, and this is just literally something which the regulator decides, then it can become part of a package of collateral for a bank to obtain financing from its national central bank. So by doing this, what happens is that the bad debts are moved from the national level into the Eurozone level. And the way in which this was facilitated is it goes into the settlement system, which is called TARGET2. Now, the way TARGET2 was meant to operate is that, let us say, a German company sells some machinery to an Italian company. The Italian company pays for the machinery to its bank, and the instructions basically are all there that it goes to, let's say, the account at Deutsche Bank for the machinery manufacturer. Okay, but the routing of it is it goes from the buyer's bank to the central bank into the TARGET2 system, which in this case would be the Italian central bank, which then goes to the German central bank, the Bundesbank, which then credits the account of the German bank, Deutsche Bank in this case, for the account of the manufacturer. Now, this creates an imbalance, obviously, because you have got a deficit arising in Italy and a surplus ending up in Germany. But what usually happens is that is recycled. German tourists going to Italy, for example, and spending money there. Also, in the capital markets, it would be recycled by institutions buying Italian debt. Now, because the whole thing is guaranteed in the system, you can see that, in theory, there should be no worries about buying Italian debt, okay? Because it's all part of the Eurozone and the whole system is all guaranteed and so on and so forth. That was fine until the Lehman crisis happened. After the Lehman crisis, the wheels started coming off the Eurozone wagon. And you may recall, you had the Greek crisis, you had the Cyprus crisis, and you had various other sort of nasties. You had Portugal, and everybody rushed around and tried to save Italy and Spain and so on and so forth. There were huge, huge problems, all of which were buried successfully, absolutely fine. But the consequence of this was that imbalances started to arise on the TARGET2 system. And they've now got to this situation where the Bundesbank is owed €1.25 trillion by the system. The national central banks owing money into the system include the ECB itself, because the ECB has been buying, say, Italian government bonds as part of its overall financial rescue package, etc. And those bonds have resided with the Banca d'Italia, the Central Bank of Italy, and effectively not paid for. So you can see that this system is basically abused. Now we come back to the situation where bad debts are being hidden in the TARGET2 system. And this has been going on ever since the crises in the wake of the Lehman crisis, the Eurozone crisis in the wake of that crisis. So going back to the Bundesbank's problem, they're owed all this money, €1.25 trillion, and rising and beginning to rise more rapidly. Now, if you're sitting in the Bundesbank as a director of the Bundesbank, you must be thinking, this is terrible. And it's even worse, because if the system collapses, then you lose all that, and instead you have to chip in to save the system to the tune, on the current imbalances, I would estimate of around about €400 billion. So you go from having an asset which you've got to write off, a debt to you, a credit, which you've got to write off, which is going to actually fundamentally undermine your own balance sheet, to having to pay out up to 400 billion in order to rescue the system. Now, this is a horrific thing. And if you're a director of Deutsche Bank, sorry, of the Bundesbank, you're sitting there thinking, what can I do about it? Nothing, because you cannot do anything to bring the system down. I mean, you're going to create your own destruction doing that. And this is the irony of the situation. It is impossible for the bank system to correct the imbalances that have been produced as a result of the flaws in the setup. And therefore, the whole system is ready to implode at any moment. It could happen at any moment. I go back to the commercial banks. The most highly geared banks, big banks in the world, are in the Eurozone. And they're highly geared on the following metric. If you look at the market capitalization to the actual equity on the balance sheet, you find that some of the big French banks are trading on as much as 100, it's around about 15%. In other words, the market value in the market of balance sheet equity is only about 15%. Now, this tells you that the market's saying the bank is only worth option money for its survival, but actually this should not be trading. It's bust. And if you look at the relationship between the market capitalization and the total balance sheet in something like some of the big French banks, what you're then looking at is a relationship of over 100 times. In other words, the capital represents less than 1%. The capitalization of the market represents less than 1% of the total balance sheet. So you can see very little needs to go wrong to just wipe that out completely. Those banks are effectively bust. They should not be trading. This will be realized at some stage. Now, I'm not saying that they won't be rescued. Of course they will be rescued because they can't afford to do anything else. There is a possibility that in a general banking crisis, some nations will resort to bail-ins as opposed to bailouts. Now, if they do that, basically what they will do is they will create a complete collapse in bank bond market financing. So this is a situation which is actually fraught with all sorts of unintended nasties, which once one bank goes, and it needn't necessarily be one of the really big ones. I mean, if you look at the rating of Commerzbank, for example, that is almost as bad as Deutsche Bank on that market capitalization to balance sheet total. We're looking at well in excess of 50, 60, 70 times. There's again, if Commerzbank went, that is not a globally systemically important bank. This is one which doesn't have to have the capital buffers that a GSIB has to have under Basel III. So, I mean, the answer basically is that I think the financial crisis that usually comes at the end of a bank credit cycle, the expansionary phase, when everybody starts beginning to worry about systemic risk. I'm talking about bankers. And they try and contract their balance sheets. Where it will first fall over, I think, is likely to be in the Eurozone.
Wow, that's quite a bit to digest there. I mean, I started off asking if we think the U.S. would default, but instead, I think I need to ask what happens if this whole Target2 system falls apart.
Well, exactly. I mean, it will be the end of the Eurozone. It is as simple as that, because it will destroy the currency. And remember that if this is not, if you like, the sort of classic textbook inflationary situation. There is inflation. It's understated because, firstly, you can't actually measure an increase in the general level of prices, and the CPI measurement is designed to play the whole thing down, to give leeway to the central bank, as it were, so that it can expand its balance sheet, it can go and intervene, it can push money into the economy without seeing prices rise. But of course they are rising, it's just they're not recorded in that statistic. So, statistics, you can prove anything with statistics except the truth, and that is an example of why that aphorism is absolutely spot on. I think that the political consequences are going to be enormous, obviously. It will be very nasty for the debtors. I mean, some people like to think, well, if you have a currency collapse, it just wipes out the debts. But what they fail to recognize is that the situation of the debtor country then is that it can't finance anything at all. And the effect on the people is extremely serious. It really is. Countries like Germany, for example, which are more savings than consumer driven, their savings are just completely wiped out for the third time in 100 years. First time 1923, second time 1946, not 45-6, and now it's going to happen again. I mean, I think it will be the whole end of the European project. I really do. I mean, obviously Brussels will struggle to keep control as any government will in a situation like that. But I cannot see how they can hold it together when you get a banking crisis, a TARGET2 crisis, and a collapse of the currency as a result.
So I guess that opens up the possibility of nations in Europe once again going back to their own sovereign currency, perhaps.
Yes, and what they will need to do is not just go back to a sovereign currency, but they will need to ensure that the sovereign currency is stable and is not available to be used by the government as a source of financing. And that basically means that they will have to back it with something tangible. Tangible money, the money that you and I would normally accept in the lieu of government currencies, of course, is either gold or silver.
You touched on the 20s a little bit here. And in a recent article, you wrote about the similarities between the situation today and the end of the roaring 20s. They included the depression that followed, of course, as we know. But what were the similarities that you observed between then and now?
The two big similarities were the expansion of credit in the 1920s, echoes the expansion of the credit since the Lehman crisis. And the other thing is that in October 1929, Congress finally passed the Smoot-Hawley Tariff Act on to President Hoover for him to pass it into law, which he did the following May. I think it was May or June. The Smoot-Hawley Tariff Act raised tariffs on all imported goods by an average of somewhere between 20 and 30%, depending on what it was. When Congress passed that, that was October 1929. That was the month when, from the September high, the market lost 33%. I mean, literally, Wall Street just, it wiped out 33%. There was then a recovery phase before it finally started sinking down to the ultimate low, where the market lost 90% from top to bottom. We have a similarity now because in, I think, round about early January this year, the S&P peaked. It lost 33%, and that was until March the 22nd. On March the 16th, the Fed came out and cut interest rates from its Fed funds rate from 1% to 0. On Monday the 23rd, the FOMC came out and effectively said, we will do infinite QE, whatever it takes. So now there's something about QE which people have got to understand. The idea that QE creates government debt is actually completely wrong. Because what's happening is, the debt is the mechanism whereby the money is created. But actually what happens is that the debt is issued into the market. It is then bought back by the central bank at a pre-agreed price and resides on the central bank's balance sheet. In return for that, the central bank pushes an equal quantity of money into the economy, or more correctly, into the reserve accounts of the banks on its own balance sheet. So that's how it sort of balances out. But the idea that this is debt is completely wrong, because it is owned by the government itself through its central bank. It is not owned by the public in any way. The debt is owed by the government to itself. So it actually really doesn't matter. But what really does matter is that it has created the money which is injected into the economy and debased the earnings and the savings and everything else of everybody in the economy. It is a transfer of wealth, if you like, and earnings from the productive side of the economy into the generally unproductive government. So what you're doing is you're just, at the end of the day, replacing taxes which you cannot get in sufficiently to cover your spending, the government spending, with printing money. And, the idea that you just print money and it doesn't harm anybody is, self-evidently, I mean, if you believe in that, you believe in perpetual motion. It's just not true. So this has now become a means of government financing. And if we look at, since March, that important moment, the 23rd, when suddenly everything took off, and it took off because the Fed said, don't worry, we'll put however much money into the system as is required through QE. So the S&P took off, copper took off, oil began to take off, and then you had this debacle in the futures market in April when people people found that it was delivered to them and they had nowhere to put it. But other than that, oil has taken off. It's trading something like $40 now, up from 20 odd or something. Gold also took off. Silver also took off. Now, I would say that gold and silver didn't take off, or particularly gold didn't take off as much as, say, copper. But then we know that the establishment does not like gold. It does not like gold because it shows up the inadequacies of fiat currency. So they suppress the price of gold. And we're seeing a suppression going on at the moment. The suppression will eventually fail because the only sound money basically is metallic money, which is gold and silver. So the situation now is that if you look at the financing in the second half of America's fiscal year, which was from March to September, the printing of money as a source of finance by far exceeded tax revenue. In other words, the US administration is now entirely dependent on printing money in order to balance its books. You might suggest that, well, if the economy recovers and all the rest of it, then that situation will right itself. Well, I would say two things about that. First of all, the lesson of 1929 to 1932 was that is not going to happen, given that you've got the end of the bank credit cycle. I mean, I've already referred to the situation the Eurozone banks have got in. They're not the only banks in this situation. The most stable banks, probably in terms of the relationship between market capitalization and the balance sheets, are the large American banks. Brilliant, but they've got counterparty risk all over the place. So the Chinese banks are very highly leveraged. Some of the British banks are very highly leveraged. And remember, we've also got Standard Chartered and Hong Kong Shanghai Bank, whose business is very much Hong Kong, China, Southeast Asia, and therefore on current American foreign policy, highly exposed, if you like, to anything that might happen in that region. So, we've got problems here. China's got problems. The Japanese banks, some of them are pretty highly leveraged as well. I mean, it's all a very uncomfortable situation. It's a situation which requires the continual support, if you like, of asset prices, financial asset prices, in order to continue. And the moment that fails, it's gone. And it's very, very serious.
So I guess you would say that the case for gold today has never been stronger against the current backdrop of all this central bank monetary inflation and debt accumulation by governments.
Yes, that's true. And the interesting thing is that the only people who really have gold, I mean, apart from central banks, are sort of almost committed gold bugs. The general public, and certainly the investment management industry, have virtually no physical gold whatsoever. So they risk being wiped out by this almost entirely. the investment, and it's interesting because the investment management industry is now just beginning to embrace an alternative to fiat currencies, and that is in the form of cryptocurrencies. I mean, they're beginning to buy Bitcoin, but then you have to ask yourself the question: once fiat currency is gone, how are you going to price Bitcoin? I mean, is it going to be the money of circulation? In other words, it's got to have a value. And if you consider it, it then comes down to, are you pricing Bitcoin in gold or are you pricing gold in Bitcoin? And when you consider that question, it becomes a lot clearer that all Bitcoin and other cryptocurrencies are a phenomenon which has arisen through the death of fiat currencies. Once fiat currencies go, there is no reason for their continued existence. And that's an important point. So it looks to me as if, there are various influences here. The first thing that Bitcoin has done, which is completely new, is it's educated a tech-savvy element in the population about why they should exist, and that reason being the debasement of fiat currencies at an accelerating pace. So they already realize that this is happening. The solution to it, however, is very unlikely to be a cryptocurrency because it doesn't have the stability, if you like. I mean, can you imagine pricing something in Bitcoin? You're beginning to think, should I hang on to my Bitcoin or should I go and buy some food? Bitcoin might go up tomorrow. So, it's not stable enough to act as money because money has to have the objective value in a transaction. You and I can agree at this moment in time what a dollar is. You may desire a dollar more than me, in which case, if I've got something to sell, I can sell it to you and I can get your dollar. But we both agree an objective value for the dollar. The price variation is all in what we buy and sell to each other, the goods that we buy, the goods and services that we buy and sell to each other. That cannot work with Bitcoin for that very simple reason that it is too volatile. You can't have that objective value in a cryptocurrency. You have it in gold and you have it in silver. We've had it for the last 5,000 years. And when fiat currency goes, gold and silver are there again for exactly that purpose. It is not a problem. If you think even further, there is another problem, and that is that we use money not just for day-to-day purchases, but we also use it as a means of financing production. We need capital, if you like. If I'm going to make something, if I plan to make something, or if I need to get new machinery for my business, I have to have capital, which I invest in that, which basically means that that money will not be freed up for some period of time. So how can I make the business calculation required for me to produce anything or to innovate with something that fluctuates and doesn't behave like stable money? So that is probably as important. In fact, I think it is almost a more important reason than the fluctuations of day to day. And nobody seems to have considered this. So, but the interesting thing is, therefore, we can only conclude that on the demise of fiat currency, the only money that will come back or can come back is gold and silver, the metallic monies.
I myself always wondered, okay, if you have a set amount of Bitcoin, once that last Bitcoin is mined, how does it account for all the products in the world, the goods and services, the population of people, all the things we need? That currency supply can't expand, it can't contract. So how can you account?
Yeah, I mean, the point about gold is if you look at the accumulation of above ground gold, it accumulates at roughly the rate of the growth of the global population. Now, this is important because it means that gold broadly keeps in line with the economic demands that are placed on it as money. As you rightly point out, this is not true in the case of Bitcoin, which I think in 2024 or something, that's it, finish. or that is intended. I mean, it's wonderful if you're a bull of Bitcoin, sort of thinking, well, this means it's going to go on up forever. But in order for that to happen, it actually has to, after fiat currencies go, it has to actually operate as money. And I've just explained why that cannot happen. So I think a Bitcoin's bull's hope is the death of paper currency takes a long time to come about. And the longer it takes, the higher up the Bitcoins and the Ethereums of this world can actually go in terms of value. I mean, meanwhile, they do operate as a store of value, which is absolutely fine. But the point I'm making is the moment fiat currency dies, then cryptocurrencies will die with it.
Alasdair Macleod, before we wrap up, can you let our viewers know more about Goldmoney and how they can benefit from its services?
Yes, of course. Goldmoney was founded by James Turk back in, I think, 2002. And we were eventually taken over by a Canadian operation which wanted to do what Goldmoney was doing. So we're now listed on the Toronto Stock Exchange, the junior market there. And what we do basically is that we arrange for the storage of our customers' gold and silver, platinum group metals outside the banking system, but in properly insured and secured vaults. So we use the same vaults that the London Bullion Market Association uses, for example. But the gold and silver that our customers have is segregated and owned by them. We're just custodians. It does not appear on our balance sheet or anything like that. We also offer a debit card system so that you can effectively spend your gold and silver if you wish to do so by those means. And I think that in the demise of paper currencies, that might be something which could be useful. As you may imagine, in the current climate, we're beginning to attract more and more customers, and not only that, but the amount of bullion under storage has increased really quite significantly recently. I think we're now over 3 trillion or something like that. What else can I tell you about it? I think it's very, very important to have the facility to store your wealth outside the banking system, and maybe even outside the jurisdiction where you reside. So an American, not you, an American resident might think either Singapore or Switzerland. We can offer that facility. And I'm not saying that an American should disobey the laws. What I'm saying is just make it a little more difficult for the American government in the extremes to which it will be driven to get its hands on your gold and silver. So there are several levels where this is important, and I think it's going to become particularly obvious if I am right about the problem in the banking system, and particularly where it might fall over first in the Eurozone.
Yeah, completely agree. I mean, in my case, I'm an American who realized this and stored myself in a different jurisdiction. So completely agree with you there. Alasdair Macleod, we appreciate the time you've given us, and I hope we can do this again soon.
That's very much my pleasure.
That was Alasdair Macleod, Head of Research at Goldmoney, sharing with us his invaluable insights about precious metals and sound money. To find out more about Goldmoney, please visit their website, goldmoney.com. If you like this video, please hit the like button and subscribe to the SBTV channel to be updated on new content. And do also check out the SBTV podcast on iTunes and Spotify.